Most people assume that if their investments earn a reasonable average return over time, everything should work out. If the market averages 7% a year, then retirement should be fine. But there is a small detail that can make a huge difference. Two retirees can have the exact same investments. They can experience the exact same average return. And yet one of them can run out of money years earlier than the other. The reason is something called sequence risk. And today, I want to explain what that means and why it matters when planning retirement. No complicated maths, just the basic idea. First, let's talk about what sequence risk actually is. Sequence risk is simply the risk of a bad market returns happening early in retirement. That's it. It's not about the average return over 30 years. It's about the order those returns happen in, the sequence. When you're still working and adding money to your investments, the order of returns usually doesn't matter too much. If markets fall one year, you're often still contributing. You're buying investments at lower prices. And over time, the ups and the downs tend to balance out. But retirement is different. Once you retire, the direction of the cash flow changes. Instead of adding money into your portfolio, you're taking money out. And that changes how market downturns affect you. Let's look at a simple example. Imagine two retirees. Both retire with the same amount invested. Both withdraw the same amount each year to fund their lifestyle. And over the next 20 or 30 years, the market produces the same average return for both of them. But the order of those returns is different. One retiree experiences a few strong market years early on. The other retiree experiences a market downturn right at the beginning of retirement. Even though the long-term average return is identical, the outcome can end up very different. The person who had the strong returns early often ends up in a much stronger financial position later on. The person who experienced losses early may struggle to recover, and the reason comes down to withdrawals. When markets fall during retirement, you still need to fund your living expenses. That means money has to come out of the portfolio. But when you sell investments during a downturn, you're selling them at a lower price. And those investments are no longer there to benefit when markets eventually recover. Over time, that can permanently reduce the size of the portfolio, even if markets perform well later. The recovery helps, but there is less capital left to recover with. And that's the core idea behind sequence risk. Losses early in retirement can do more damage than losses later. Here's a simple way to picture it. Imagine you have a bucket of water. Your investments are the water in the bucket. Your retirement spending is like scooping water out each year. If the bucket stays full, you can keep drawing water comfortably. But if a bucket loses a lot of water early and you're still scooping water out, the bucket empties much faster. That's essentially what happens when market downturns occur right at the start of retirement. Losses reduce the level of the bucket. Withdrawals keep removing water. And the portfolio can shrink faster than expected. This is one of the reasons retirement planning is different from investing while you're still working. During your working years, market downturns are often temporary setbacks. You're contributing regularly. You have time for markets to recover, and lower prices can actually help long-term investors. But during retirement, the situation flips. The portfolio now has to support withdrawals. Market downturns, combined with withdrawals, can create a more fragile situation, which is why the timing of returns becomes important. Now, this doesn't mean retirement investing needs to be overly complicated. But it does mean planning for retirement isn't just about chasing the highest possible return. It's also about managing risk in the early years of retirement. There are a few simple ideas that can help reduce sequence risk. One common approach is having some form of cash buffer. Instead of withdrawing money directly from investments every year, a retiree might hold 1 or 2 years of spending in cash or very stable assets. If markets fall, that cash can fund spending temporarily. That means investments don't need to be sold during the downturn. It gives the portfolio time to recover. Another important idea is diversification. Not all investments move in the same way at the same time. Holding a mix of assets can help smooth out the ups and the downs. It doesn't eliminate market risk, but it can reduce the impact of large swings. Flexibility can also help. Some retirees have the ability to adjust spending slightly when markets fall. That might mean delaying a major purchase, taking a smaller holiday, or reducing withdrawals temporarily. Even small adjustments can make a meaningful difference over time. And finally, having a sensible withdrawal strategy is important. Taking too much out of a portfolio early in retirement increases the pressure on the investments. A well-planned withdrawal rate can make the portfolio more resilient through different market conditions. Now, I want to be clear about something. Sequence risk doesn't mean markets are dangerous, and it doesn't mean retirees should avoid investing. In fact, investments are often essential for retirement portfolios to last over several decades. What sequence risk highlights is simply this. Retirement planning isn't just about how much money you have invested. It's also about how that money is managed over time, especially during the early years of retirement. So the key takeaway is quite simple. 2 retirees can experience the same average investment return, but if the bad years happen early for one of them, the outcome can look very different. That's sequence risk. It's the idea that the order of returns matters when you're withdrawing from your investments. Which is why retirement planning often focuses on things like diversification, cash buffers, and sensible withdrawal strategies, not just long-term returns. If you're approaching retirement, understanding this concept can help you think differently about how your portfolio is structured and how you plan to draw income from it. Because a good retirement plan isn't just about building wealth, it's about helping that wealth last. If you found this explanation helpful, I'll be covering more topics like this around retirement, investing, and financial planning here on the channel. Thanks for watching.